studying your last two. I swim med when turned in. The styrene down to mute. And can learn the pole that sunk he died.
One of the most confusing terms in Canadian corporate taxation is refundable dividend tax on hand, commonly called RDTOH. The name itself sounds technical, but the underlying idea is actually quite simple. The first thing to understand is that RDTOH is not a separate tax. It is not an additional amount that the corporation must pay. Instead, it is a bookkeeping account that keeps track of taxes the corporation has already paid and may be able to recover in the future. Let's see how this works. Suppose a corporation earns investment income, such as interest, dividends, rental income, or taxable capital gains. Because investment income is subject to a relatively high initial corporate tax rate, the corporation pays a significant amount of tax to the Canada Revenue Agency. However, not all of that tax is intended to remain with the government permanently. A portion of the tax is recorded in a special tracking account called the Refundable Dividend Tax on hand, or RDTOH. You can think of this account as a secure vault that temporarily holds refundable tax credits on behalf of the corporation. Now imagine the business owner asking, can the corporation ever get this money back? The answer is yes, but not immediately. The corporation generally becomes eligible to recover part of this tax after it pays taxable dividends to its shareholders. When those dividends are paid, the corporation may receive a dividend refund, allowing it to recover some of the tax that was previously recorded in its RDTOH account. This is why RDTOH is often described as a temporary holding account. Money goes into the account when the corporation pays tax on investment income, and some of that money can come back later when dividends are distributed. A helpful way to think about RDTOH is to imagine a refundable deposit. The corporation pays the tax today, but a portion of it is set aside and can be refunded later if the required conditions are met. At this stage, don't worry about the formulas or calculations. The most important concept is simply this: RDTOH is not extra tax. It is a tracking account for refundable corporate tax. It exists to support Canada's tax integration system by allowing corporations to recover part of the investment income tax they previously paid after distributing profits to shareholders. In the next slides, we'll follow the flow of money into and out of this account so you can see exactly how the refund mechanism works. Now let's see how the refundable dividend tax on hand, or RDTOH, actually works by following the flow of money through the system. Think of the process as a cycle rather than a one-time transaction. The cycle begins when a corporation earns investment income. This could be interest income, dividend income, rental income, or taxable capital gains. Because investment income is taxed at a relatively high corporate tax rate, the corporation pays a significant amount of tax to the Canada Revenue Agency. But remember, not all of that tax is meant to stay with the government permanently. A portion of the tax is recorded in the corporation's RDTOH account. You can think of this account like a water tank or a storage vault. Every time the corporation pays refundable tax on investment income, the tank begins to fill. At this stage, the money is not lost. It is simply being tracked for a possible future refund. The next important event occurs when the corporation decides to distribute some of its after-tax earnings to its shareholders in the form of taxable dividends. Once those dividends are paid, the corporation may qualify for a dividend refund. This is when money begins to flow back out of the RDTOH account. In our water tank analogy, paying dividends opens the valve, allowing some of the stored refundable tax to flow back to the corporation. At the same time, the shareholder reports the dividend on their personal tax return and pays personal income tax on the dividend received. When you look at the entire cycle, you can see how Canada's tax integration system works. The corporation first pays a high amount of tax on its investment income. Part of that tax is tracked in the RDTOH account. Dividends are eventually paid. The corporation receives a refund, and the shareholder pays personal tax. A simple way to remember this process is with two short phrases. Fill the account by paying tax. Empty the account by paying dividends. Whenever investment income generates refundable tax, the RDTOH balance grows. Whenever eligible dividends are paid and a dividend refund is received, the balance decreases. At this stage, don't worry about calculating the refund. The most important concept is understanding the flow of money. Investment income fills the RDTOH account. Paying dividends allows the corporation to recover part of that tax. Once you understand this simple cycle, the detailed calculations you'll see later become much easier to follow. Let's put everything we've learned together by following the complete journey of the refundable dividend tax on hand, or RDTOH, from beginning to end. The story begins when a corporation earns investment income. This income might come from interest, dividends, rental properties, or taxable capital gains. Because investment income is taxed at a relatively high corporate tax rate, the corporation pays a significant amount of tax to the Canada Revenue Agency. However, not all of this tax is intended to be permanent. A portion of the tax is recorded in the corporation's RDTOH account. Remember, this account is simply a bookkeeping record that tracks refundable tax. At this point, the corporation has paid the tax, but it may be able to recover part of it later. After paying the tax, the corporation may choose to retain its after-tax earnings inside the business. There is no refund simply because the corporation earned investment income. The refundable tax remains recorded in the RDTOH account until another important event occurs. That event is the payment of a taxable dividend to the corporation's shareholders. Once the corporation distributes a taxable dividend, it may become entitled to receive a dividend refund from the Canada Revenue Agency. This refund allows the corporation to recover part of the refundable tax that had been accumulated in its RDTOH account. At the same time, the shareholder reports the dividend on their personal income tax return and pays personal tax on the dividend received. When you step back and look at the entire process, you can see how Canada's tax integration system works. The corporation initially pays a high amount of tax on its investment income, but part of that tax is refundable once the profits are distributed to shareholders. The shareholder then pays personal tax on the dividend, helping ensure that the overall tax result is broadly comparable to earning the investment income personally. This is why RDTOH exists. It recognizes that investment income is taxed heavily at first, but it also provides a mechanism to refund part of that tax after dividends are paid. The system helps prevent excessive taxation while preserving the principle of tax integration. As you continue studying corporate taxation, it's important not to become overwhelmed by formulas and calculations. Instead, focus on understanding the story. The corporation earns investment income, pays a high initial tax, records the refundable portion in the RDTOH account, pays dividends, receives a dividend refund, and finally the shareholder pays personal tax. Once you understand this sequence, the mathematical calculations become much easier because you'll know why each number exists and how it fits into the overall system. The key takeaway is simple. RDTOH is a bookkeeping account that tracks refundable corporate tax. It allows a corporation to recover part of the investment income tax it previously paid after distributing dividends, helping Canada's tax integration system work as intended.